In 2008, the richest nation on Earth watched its own foundations collapse. Homes were abandoned, banks evaporated, retirement accounts vanished overnight. It wasn't a war, it wasn't a natural disaster, it was debt. And the American dream had been mortgaged to the highest bidder. This is the story of the 2008 housing crash. For decades, home ownership was sold as the safest path to wealth. After the 2001 recession, the US government lowered interest rates to stimulate growth. Money became cheap, credit became abundant. Banks began offering mortgages to almost anyone. Income verification? Optional. Down payments? Minimal. Risk? Ignored. These were called subprime mortgages, loans given to borrowers with weak credit histories. But banks weren't afraid, because they weren't planning to keep the loans. Here's where the system changed. Banks bundled thousands of mortgages together into financial products called mortgage-backed securities. Lehman Brothers, Bear Stearns, Goldman Sachs. Investment banks sold these securities to pension funds, insurance companies, and global investors. The logic was simple. If one homeowner defaults, the others will keep paying. Rating agencies stamped them AAA, the highest safety rating. Wall Street had discovered alchemy. It had turned risky debt into safe assets. But the real weapon wasn't the mortgage, it was leverage. Banks weren't just selling mortgage-backed securities, they were betting on them. Through complex derivatives called credit default swaps, institutions insured and speculated on mortgage failures. One firm stood at the center of this storm, American International Group. AIG sold massive amounts of insurance on mortgage securities. If those mortgages failed, AIG would have to pay billions. The problem? They didn't have the money. But no one expected housing prices to fall nationwide because housing always goes up, until it doesn't. By 2006, home prices had peaked. Adjustable rate mortgages began resetting at higher interest rates. Monthly payments exploded. Defaults began rising. The entire financial system had been built on one assumption: housing prices will keep rising. When they stopped rising, the pyramid inverted. Mortgage-backed securities lost value. Banks that had borrowed heavily to buy them faced margin calls. Liquidity vanished. Confidence collapsed. Then came the moment that froze the world. On September 15, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in US history. Money markets panicked. Credit markets froze. Businesses couldn't access short-term funding. The global financial system nearly stopped functioning. Within days, Bear Stearns had already collapsed. American International Group required a massive government bailout. The US government launched the Troubled Asset Relief Program. Wall Street was rescued, Main Street was not. Millions of Americans lost their homes. Unemployment surged past 10%. The Great Recession had begun. The government argued the system was too big to fail. Banks were injected with hundreds of billions of dollars. But here's the deeper question. If the system collapses when debt stops expanding, was the system ever stable? The 2008 housing crash revealed something profound. Modern finance doesn't run on savings. It runs on leverage. It runs on confidence. It runs on the belief that tomorrow's debt will justify today's risk. The housing crash wasn't just about greedy bankers or irresponsible borrowers. It was about incentives. Banks made money by issuing loans, not by ensuring repayment. Investors chased yield, not safety. Rating agencies were paid by the very institutions they rated, and consumers were told debt was wealth. The system rewarded expansion. It punished caution. When credit expands, asset prices rise. When credit contracts, everything falls. The crash wasn't a glitch, it was a reset. In 2008, America learned that houses were not just homes, they were collateral. And when collateral fails, the illusion collapses. But the deeper lesson is this: debt is not money. Debt is a promise about the future. And when a society builds its prosperity on promises instead of productivity, it mortgages tomorrow to finance today. The 2008 housing crash was not the end, it was a warning. Because the age we live in is not the age of gold, not the age of industry, but the age of debt.